Hi accounting class, it's another great day to do some accounting. Today we're going to be looking at chapter 6, which is inventory costing methods. In the previous chapter we introduced a merchandising business which sells products. Today we're going to be looking further into inventory and see a problem that businesses who sell inventory will encounter. Alright, so this says that they're experiencing substantial increase in sales, but their vendor is slowly increasing the price at which they sell food to us. So their prices are going up over time. This is normal with inflation in America, so prices typically go up over time. Alright, so our job is to value inventory at cost under the cost principle. Alright, so let's see the problem here. This is their inventory report as of March 31st. They have this bulk premium dog food. They have different quantities of it. They have it on 3 different layers here because they're at different costs. You see the cost is going up over time. And then we have the total cost and the total value of the inventory. So it's on our books for $2,635. On April 1st, they run a promotional sale. They sell 90 units of it for $25. If we multiply 90 times 25, we get to the total revenue. So they earn total revenue of $2,250. Now the only problem with us is which ones do we expense? Do we expense the ones at 18, the ones at 1750, the ones at 17, some mixture of the two? Well, the answer is it depends on what cost flow assumption we adopt. So a business has a choice on which cost flow assumption they adopt. We're going to look at 4 different options here. These are the most popular 4. Actually, the most popular are the first 2, FIFO and LIFO. And then we'll look at average cost and specific identification. So the answer is it depends. They have to adopt some type of cost flow assumption. Sorry. Alright, so under FIFO, FIFO stands in for first in, first out. Under this example, the first inventory that's in the population will be the first one that leaves the population. So the first one in the population are these at 17. So we have 40 at 17 will be expense, but we sell a total of 90, so that doesn't get us to 90. So we have to go down the list. So FIFO will tell us to start at the top of the list and work our way down effectively. Start at the most recent and work our way to the more recent cost. So if we expense all these units, cost of goods sold will be the 40 times 17. So we're expensing all of these. And then we're going to pick up the others at 1750. Notice it's a total of 90 units that we sold. FIFO would expense or have that as cost of goods sold. The ending inventory would just be what's left, the 60 at 18. Alright, LIFO. LIFO is just the opposite of FIFO. It says the last one in is the first one out. Last one in, first one out. So cost of goods sold under this example, well, we'd get 60 units here at 18. We're going to start at the bottom and work our way up under LIFO. And then we need to get not all 50 of these. We only need to get to 90. So we only need to grab what? We got 60 here. So we need 30 additional ones. So we need 30 out of this next tier to reach a total of 90 units. So let's see the math. We'll explain it one more time. So we're taking all the units at 18. That gives us 60 units. But we need 30 units more to reach a total of 90. So we're going to take 30 from this population, 30 at 1750. Notice our cost of goods sold in this example is $1,605. Our ending inventory will be what's left, the 40 at 17 plus. If we sold 30 of these, there's only 20 left, so 20 at 1750. So the cost flow assumption tells you which ones we're going to expense, either the first ones, the last ones. The other approach here is called average cost. Under this approach, for every purchase, a new average cost of inventory is calculated. So average cost of inventory, to find out the average, what we're going to do is take, effectively we multiply these across to get the total cost. So 40 times 17 equals 680. Multiply it across, multiply across. We get the total value of the inventory and we divide by the total quantity of units in that inventory. So this number divided by that one will give us the average cost of inventory. Now, on average, everything's done at average. So cost of goods sold will be the number of units we sold times the average cost, and the ending inventory will be the number of units left times the average cost. We sold 90 units, 90 times 1757. equals 1,581. The ending inventory, let's see, we had 150 units, we sold 90 of them, so we have 60 units left. 150 minus 90 is 60. 60 times 1757 equals $1,054. So under average cost, the new average is calculated every time inventory is purchased, and then everything is valued at the average cost. So all of it has one cost, which is the average cost. Alright, specific identification isn't technically an assumption at all. What we do here is we tag every item. We individually tag it. A great example is the VIN numbers on vehicles. They don't have to have FIFO or LIFO or average cost assumption. They know exactly which one they're selling because every vehicle is specifically identified. So under this one, everything has to be specifically tagged. It's usually for larger items. So here it's going to tell us, assume of the 90 units, 20 were from the first transaction, 30 were from the middle transaction, 40 were from the last transaction. So it tells us which ones because they have it specifically tagged. So 20 from the first one, so it'll be 20 times 17. 30 from the second one, so 30 times 17, 50. And then 40 times 31. Let's see the cost of goods sold. See, we see the 20 at the first cost, 30 at the second one, and then 40 at the third one. Multiply and then add all those together, you get the total cost under specific identification. Ending inventory will be the units that are left. So we'd have 20 units left at 17, 20 units left, 50 minus 30 is 20, and what we sold 40 of those, so we'd have 60 minus 40 is 20 units. These two should add back up to the total inventory. Should be the case in all of them. May be off a bit from rounding, we'll see. 2635. No, it ties exactly 2635. So in this, all of the methods, the total amount of expense and the total amount of the asset should equal the total amount of the total cost of the inventory. Alright, so let's look at this. Under FIFO, LIFO, average cost, specific identification, we're going to look at an income statement. Notice here the sales number stays the same. It doesn't matter how you're treating your cost, your sales numbers will stay the same. Cost of goods sold, though, these numbers come directly from the previous page. 1550, I'm going to show you. 1550, so they're just coming from the previous page of the cost. And this influences their gross profit or their net income in this example. So FIFO we see is 695, LIFO, and there's really no change in the business except for what cost flow assumption they adopted. So the important thing here is the cost flow assumption can influence a business's net income. And we're going to get into the discussion of which one we should choose based on that in a second. We can note that average, like an average, always falls between the two extremes, FIFO and LIFO. FIFO and LIFO are the two most common, if you ever see it on a multiple choice question. FIFO expenses the oldest cost, but it leaves more recent cost on the balance sheet. So FIFO will expense the oldest cost, but leave the most recent cost on the balance sheet as an asset. LIFO, it's harder to think of a real world example here, but under LIFO, more recent costs are expensed and older inventory is left on the balance sheet as an asset. Alright, now we're going to compare the two most popular, LIFO and FIFO, under a period of rising prices and a period of lowering or declining prices. This gets a little bit complicated. If you don't get the logic, you can just record the summaries so you can answer the multiple choice. But if prices are generally rising, then older costs are cheaper, right? Because costs are going up over time, so the older costs are going to be cheaper. Newer costs are more expensive. FIFO expenses older costs, which are cheaper in this scenario, which result in a higher net income. Right? There's an inverse relationship between cost and income, right? As your costs go up, your income is lower, or in this case, as your costs go down, your income goes higher. There's an inverse relationship between cost and income. So as we expense less, our income is higher. FIFO also reports more recent higher cost as merchandise inventory, which results in a higher ending inventory balance. So if prices are generally rising, FIFO produces a higher net income than LIFO, and FIFO produces a higher ending inventory balance on the balance sheet than LIFO does. Alright, a quick little memory trick for this one is to associate the L in the word LIFO to be the word lower. So if prices are rising, and only if prices are rising, LIFO produces a lower net income and a lower ending inventory balance. Here the rules just flip around. These aren't as important, I don't think. We'll see if they're in the multiple choice. But if prices are decreasing, the rules just flip. Here LIFO is higher net income and LIFO produces a higher ending inventory balance. So if you flip the direction of the price change, it flips the outcome for both net income and ending inventory. I would just know these. Associate L and LIFO as being lower. So LIFO produces a lower net income and a lower ending inventory. If I see that prices are decreasing, then I would just flip those rules around and know that LIFO actually produces a higher one under that scenario. Alright, so let's look at FIFO and LIFO more closely. Overall, FIFO is the most popular inventory method, so it's the most popular overall. But for companies that have large inventories, LIFO is the most popular inventory method, and this is going to start a discussion for us. In our country, prices are generally rising, so it's typical to see prices increasing over time in most industries. And we know that FIFO will show a higher net income and higher ending inventory balance under a period of rising prices. So in general, a corporation is owned by shareholders and their executives want to show the owners that they are running the business great and as a result show a high net income. So why in the world would anybody want to use an inventory method that showed a lower net income, right? If we pick LIFO, let's look at LIFO versus FIFO. We're going to show a lower net income to our shareholders if we pick this method versus FIFO. Why would we want to pick a method that showed a lower net income? Well, the answer to that is you don't want to appear as successful to everybody. You may not want to appear so successful to everybody. For example, these guys, the IRS. To the IRS, you don't want to appear like you're making a lot of money. Then they're going to tax you a lot. So if a business has a higher net income, therefore using FIFO, it will have a higher taxable income, as a result pay higher taxes in the current period. So a lot of businesses are going to choose LIFO because it lowers their taxable income, which results in a lower tax in the current period. Alright, before you think this is like some kind of tax fraud or something, this is called tax avoidance. Tax avoidance is the ethical one. It's based on the laws of the IRS, etc. And this is the ethical one. You're playing within the rules if you're avoiding the tax. Now there's another bad word in tax called tax evasion. So where you have like offshore tax accounts and you're trying to play with outside the tax laws. This is the unethical version. So I know in English these two words are almost synonymous, but in the tax world one means you're avoiding the tax in an ethical way, the other one means you're breaking the law. It gets into these FIFO and LIFO aren't really, they're timing differences. It just influences the timing of it. Over the entire life of a business, they're going to expense the same amount under LIFO and FIFO. So they're just timing differences. So this tax benefit, really, it's getting us tax savings today. Even though we're going to owe, the total amount is going to be the same in the future, giving us a tax advantage today, which due to time value of money, which says that money today is worth more than money in the future, it's still a benefit to us. Alright, so the IRS requires companies to use the same costing method for tax purposes they do for financial reporting. So we can't pick and choose. We can't do FIFO inventory for our investors and shareholders and LIFO for the tax IRS people. So we have to use the same one. As a result, many companies with large inventories use LIFO to get the tax advantage, and the investors are smart enough to know what they're doing. Alright, we see these terms again, perpetual and periodic. Here we're going to have a very clear winner, which is perpetual. We're not going to see the periodic method. Control of inventory. Alright, so when we have inventory, we just throw a little bit of internal controls in here. There are 3 documents in the purchase and billing cycle. So before, when we want something, a department wants something in a business, they fill out a purchase requisition saying that they're requesting something. Once it's approved by management, they sign an official document called a purchase order or a PO. This authorizes the business to spend money on that thing, on whatever they're buying. After some time, that will be ordered, and we will receive the good. Assuming it's a good and not a service, we will receive it. And at such time, we'll receive a receiving report, which says our workers have documented we've received X number of units of these goods, and so on. So we'll have a receiving report to prove that we received it, and later they will bill us for it. They'll send us a bill to pay for the goods that they sent us. So these 3 documents are very important if you're in the purchasing cycle, to match up these 3 documents and to report to investigate any discrepancy. The purchase order is the authority to spend. The receiving report verifies physical receipt, and the invoice is their bill to us that we should match up to the other documents. Like, we don't want to pay just any bill. We want to make sure we received it and we ordered it. There are scams out there where people will just send random invoices to businesses and see if they will pay them. So if you don't have controls where you line up these 3 documents, you can effectively fall prey to that. So you want to make sure when you're paying for something, you ordered it and you received it, and you were billed for the amount that you ordered and received, and there's no discrepancy. The control of inventory, this is simple. We all know people in this world steal, so that's all this example is. They have a total value of inventory on their books at $22,190. They do a physical count of the goods. Businesses usually do this once a year. Almost all retailers do. And they count it, and they only have $21,430. What happened to the difference? Who knows? Probably stolen, damaged, whatever. So if you subtract the 2, you get a $760 difference. Let's just go and see how we're going to record it. We're going to call it inventory shortage expense. Again, other businesses may use different terminology here, but this is one that's acceptable. And then we credit the inventory. This makes perfect sense because we have less inventory than we thought we did, right? Our book should reflect the reality of the business. If we only have $21,430, then we shouldn't be reporting $22,190. So we mark down inventory. Alright, choosing an inventory costing method. Okay, so she's still a bit confused which one to choose. We're going to do it for 4 different... Okay, so we're going to do the tables now. These tables are cost tables. As being a cost table, there's one rule that you never do with a cost table. You never put a sales price into a cost table. This will throw off every table that you do. So it's the most important rule before we begin. Never enter a sales price into a cost table. And yeah, I don't want to do this for all 4 either. I don't know why she can't just pick one of these 4 methods. Now we have to do it 4 different times. 1, 2, 3, 4 different ones. God, she's annoying, isn't she? Alright. What are we doing? We have a table here. We're going to keep track of what comes in, i.e. purchases, what goes out, i.e. cost of goods sold, and then we're going to keep track of the ending inventory. This one's different than the other 2. This is cumulative in nature. This tells us what happened during the transaction, whether something went in or left, and then this one tells us the balance after something came in or left the population. For one, we had 50 units at 15. Oh, we just had them, so they're part of our beginning inventory. So we started with these. It's not really a transaction. Next, we sell units at $25 a piece. We sell 30 units at $25 a piece. So we're going to go cost of goods sold. We sold 30 units, and we're not going to use the 25. We're not going to use the 25 because it's a sales price. We never put sales price into a table. We're going to use the cost. The only type we have are ones at 15. So when we sell these, the cost of them is 15. We had to put the cost number, and I'm getting it from over here. That's the only type of inventory we have. We can only sell what we have, and we have 50 units at 15. So we sold 30 at 15. You can total these up. Just multiply them. Alright, so if we had 50, we sold 30. 50 minus 30 is equal to 20. We have 20 units at 15 left, right? So we did what we had minus what we sold equals the ending balance. And then we can move on to the ninth. We purchased 40 units at 17. So under the purchases, we're going to have 40 units at 17. 40 times 17 is 680, or at least I hope it is. Alright. Now let's think about our inventory. Whenever we purchase something, it's not like we throw away everything we already had. We still have what we had. In addition to having what we had, we have new stuff. So we're going to take the old population. This is still going to be part of our population. In addition to it, we have this purchase. So it's going to be the prior balance plus the amount we purchased. So we're going to have 20 at 15 and 40 at 17. Notice I have darker lines in here. The darker lines, some of these can take up more than one line. Alright, where are we? The 14th. We sell units, 40 units. Again, don't even bring this number in your mind. We sell them at 25, that's sure, but we're not going to enter 25 in our table. We sell 40 units. We're under FIFO. That may become relevant. We're going to sell 40 units. Alright, we're going to sell them from this population. Under FIFO, FIFO says first in, first out, or start at the top and work your way down. So I'm going to start off by selling these at 20 at 15, these 20 units at $15 a piece because we're under FIFO. Now I realize 20 does not equal 40, right? We need 20 more. So we're going to take the 20 additional ones from the 40 at 17. Alright, so we sold a total of 40 units and we followed the rules of FIFO by selecting first in, first out to expense. Let's see what we have left. We got rid of all the ones at 15. We expensed them all. We started with 40 at 17, but we sold 20 of them. 40 minus 20 equals 20, so we're going to have 20 at 17 left. Alright, we can move on to the next one. We purchased 50 units at 18. Alright, now we have our prior balance, 20 at 17, plus the new 50 at 18. Alright, for these tables, there's some information we can get out of them. For cost of goods sold, it's going to be the summation of this entire column. I'm going to show you the math down here too, so it's clear. For the ending inventory, it's just the value in the last box effectively. So it's just going to be the addition of 340 and 900. You don't want to do the whole column because this is already cumulative in nature. So you just want to look at the last date, figure out the value of the inventory as last date. So it should just be the sum of those two, 1240. And give you the calculation. Now we'll go through the same table, except this time it's going to be LIFO. We're going to go a little quicker. We started with 50 at 15. So under inventory, 50 at 15. We sell 30 units. Sell 30 units. The only type of units we have are ones at 15, so we sell 30 at 15. If we started with 50 at 15, we sold 30 of those. 50 minus 30 equals 20 at 15. Next date. We purchased 40 at 17. Now we have our prior balance 20 at 15, plus we had the 40 at 17. And we'll move on to the 14th. We sell 40 units. This time under LIFO. When we sell 40 units, we can get them all. We're going to start at the bottom and we can get them all from that bottom population. So we're going to sell 40 at 17. We've sold all of those, so we're left with just the 20 at 15. The 24th. We purchased 50 at 18. Now we have our prior balance of 20 at 15, and we have our new 15 at 18. I'm sorry, I said it wrong, but it's written right. We had the 20 at 15 and the 50 at 18. We're going to total these two up to get our total cost of goods sold. And we're going to total these two up to get our total ending inventory. I want you to see a relationship here. The difference between this number, the cost of goods sold in the previous table, and this one is $40. So if you subtract those two, you get $40. Also, the difference in the ending inventory is also equal to $40. So you can use that as a check figure. The difference in the two cost of goods sold between LIFO and FIFO should equal the difference in the ending inventory between the two approaches. Alright, the average costing table. The rule here is a new average is calculated every time a purchase is made. I have to highlight it, but red works. Alright, we start off with 50 at 15. Okay, I just don't have a thick line. Okay, the border's fixed. This one isn't part of the first one. So we start with 50 units at 15. On the 5th, what happened? We sold 30 units. We don't really need to calculate an average because they're all at 15. So we sold 30 units. They must be at the only cost we have, 15. 50 minus 30 is equal to 20. You've seen the same start on the previous two. On the 9th, what happened on the 9th? We purchased 40 at 17. Now we're going to have to calculate an average. So we still have the 20 at 15. We now also have the 40 at 17. What we're going to do to calculate an average, we're going to add up the 2 units. So there'll be 60 total units, and we're going to add up the total cost, be 980. And we're going to divide the two. We're going to divide 980 by 60. So division, 980 divided by 60 will get us our average cost of 16.33. This is probably rounded, most definitely. So now our average cost is 16.63. When we sell units, we'll sell them at 16.33. Next one, we sell 40 units. We're going to sell them at 16.33. We started with 60, we sold 40, so we're left with 20 units at 16.33. On the 24th, we purchased 15 at 18. So we have 20 at 16.33. And now we're going to have 15 at 18. We're going to calculate the new average. So 50 plus 20 is 70. These two added together equals that number. Divide the two and you get a new average cost. You have to do that every time a purchase is made, not necessarily a sell. Alright, the total cost of goods sold is equal to the sum of these two. And the total ending inventory is equal to these four. Alright, specific ID, we'll go and cut this one out. Specific ID, I can show you, just reveal it for anyone who wants to complete the notes, but we'll remove it. Specific ID, each inventory is specifically tagged. You can look at it, but the problem just tells you what to expense. So we'll focus on the other three on the homework and test. You might see like what is specific ID type question on the multiple choice, but you won't have to make a table. You can see a summary of the costing tables here. We can see FIFO prices are rising, so we see FIFO is higher than LIFO, than average cost between the two. Specific ID just really depends on which ones were sold, so it could be anywhere in that range. What do you recommend? It really depends. FIFO is the most popular, the smaller inventory. LIFO would give them a small tax advantage, but it's only like $40 the difference here. So if anything, you could write LIFO for the tax advantage, or other than that, it really FIFO just due to simplicity. There's really not a right answer necessarily. If they had large inventories, we could say the right answer is to use LIFO for the tax advantage, but without having a large inventory, the effects are really minimal and immaterial. We have our Chapter 6 summary. You can read through this. It gives you the most important information all in one hand. And I'll show you a shorthand way to do the inventory. Instead of having, you only need 3 different columns under this approach. So if this makes sense to you, you just use the @ sign instead of the other ones, and you gotta do some math at the end to get to your answers, but I think this is much simpler to do on a scratch piece of paper than it is having that big formal table. Alright, that's it for Chapter 6. Next time we'll be looking at Chapter 7, Receivables and Cash. But we'll see you guys next time for the next video. Let me know if you have any questions. Alright, bye-bye.